This is Chip Maxwell, and you're listening to the Retire Smart podcast with David Brooks. In this episode, David unpacks a growing disconnection between rising bond yields and falling oil prices, signaling potential economic trouble ahead. He also explores key indicators, from auto loan delinquencies to depleted savings, that suggest consumer strain and a slowing economy despite optimistic headlines. To top it off, the Labor Department admits to overstating job growth by nearly 400,000 positions, raising serious concerns about the reliability of government-reported economic data. I can see in this chart that you sent around to the team that yields in the bond market and yields in the oil market generally seem to track each other, but a huge disparity has developed in the last month or two. And what does that mean?
Yeah, so typically, you can correlate things together. When oil prices are rising, that usually means the economy is growing, right? So demand is growing, so therefore oil starts to go up, and you pay more at the pump, right? That's just, and it doesn't rip higher. It just kind of gradually goes higher over a course of months, right? The economy's heating up. If the economy's heating up, interest rates are usually heating up as well, paying slightly higher interest rates. The Fed might be in raising mode because they're trying to tame inflation. So if interest rates go higher, in theory, that would start to slow demand. And then when demand does roll over, you see oil prices fall, right? So when demand is less, oil prices fall down. When demand is less, usually interest rates fall. Well, which one's telling the truth? Because as you said, for the last, foreseeable near future here, oil prices have been falling like a rock, right? Got all the way down to $55 a barrel. I think it's back in the low 60s as we record this today. But yields are ripping higher, right? The 30-year yield is basically back almost at 5%. So interest rates are going up, oil prices are going down. Who's correct? Well, interest rates are telling you inflation is a very real problem. Oil's telling you deflation is a very real problem, and demand is the problem we should be looking at. So can I tell you with certainty which one's correct? No, but one of them is going to correct the other. Everything reverts to the mean. That's why we look at correlation charts like this. This is really important to understand. I believe oil is probably closer to the real, and you'll see interest rates fade, but just not till later this year. The reason interest rates are up so much has a lot to do with the tariff tantrum and the fear that these tariffs will cause inflation. Well, as we're seeing, the deals kind of get knocked down now, UK, among others, China, et cetera. If they are real, in fact, and yields start to soften and go down, then that would tell me that we're probably looking for a slowdown, and then the Fed's going to start to cut rates, a little bit later than Trump currently wants.
So the bond yield, more likely, is going to be the one that moves and moves downward.
I think oil can certainly rebound some, but I don't see oil going back anytime soon to $85, $90 a barrel. It may not hold down in the sub 60 level either. That gets to the point where it gets kind of spooky for those producing it. Their margins get squeezed, et cetera.
Well, here's another one of those grassroots economic indicators. Auto loans not doing so well, David.
Yeah, well, the
delinquency rate is what the graph is showing. And
used car prices started to pop up here again because of the tariff tantrum. But used car prices, if you remember, during COVID went crazy.
Oh, yeah.
Right? There was supply, and then we had some bad weather that ruined some cars, flooding, et cetera. So used car prices went almost parabolic. My poor son, he happened to have his car get totaled at the exact wrong time. And when he had to replace the car, it was about a $7,000 loss from what he got from the car versus buying a comparable car because the used prices went up
twice as much to get one.
It was bad.
To get something comparable.
And so used car prices faded, came back down here. Finally, they're starting to rise again on the tariff thing. But we're seeing delinquencies now on the loans that went on those cars. Financing those cars is starting to creep up to pretty high levels we haven't seen in a long, long time. We talked about credit cards, I think, last week, hitting all record highs of people making minimum payments. Now you're seeing auto loans start to roll. These are signs that tell us oil, maybe in that previous chart, was telling us the right direction, that demand is slowing and the consumer is running out of steam.
David, those watching on YouTube can see this next graphic. It's about U.S. excess savings, and there is a steady, about a 45-degree downward trend in savings. And your contention is that's another sign of the stimulus money drying up?
Yeah, the government panicked, and it seems to be the playbook of all elected officials now. When something happens, the proverbial, you know what, hits the fan, so to speak. Let's send out some money. Well,
throw money at it.
It'd be one thing if you had money,
then the money hits the
sitting
fan.
in the vault that you're handing out something you already had. But no, they had to create this money out of thin air. We printed money, and we did. And again, this was Republicans and Democrats. They all voted for it.
Right.
You had Trump sign bills, Biden sign bills, but we sent out over $5.7 trillion in less than 24 months mainly through the stimulus checks. There were 3 rounds of that, through enhanced child tax credits, PPP loans, and there was so much waste, fraud, and abuse in there as we're uncovering now. It's ridiculous. But those checks kind of gave people, and credit card numbers, by the way, we were talking about the delinquency rates last week. Credit cards got paid off at the fastest rate in history when that happened because people were flush with cash. You were getting these checks in the mail you didn't ask for. And again, this was the overreaction by Congress. Well, that created inflation, right? Inflation is created by M2 money supply. When you have all these dollars chasing the same amounts of goods, it's going to make prices rise. Well, we've worked off that the excess, and now we've run out of personal savings, and now the average American is negative on their personal savings rate, and they're having to charge their monthly supplies, right? You're having to use that credit card to just buy the necessities, and now you're not paying that credit card bill off. These are all bad signs for what's coming a couple of quarters out. Again, can we get some kind of tax bill actually finalized? We did, by the way, get the first version printed from the House Ways and Means Committee. They posted on their website last Friday. I've read through it, where they want to extend the tax cuts, et cetera. But this bill hasn't even got to the markup phase, so it's probably not even worth talking about yet on air because the chance of it coming out in its current form are slim and none. But again, lots of economic headwinds. Just because we announced some of these deals doesn't mean the economy's all in the clear yet.
David, we have about a minute for this one, but you sent it to me right before we sat down to do this show. A headline from townhall.com. Labor Department admits hundreds of thousands of Biden jobs were fake. I'm just going to read the first sentence. The Biden administration claimed to have added almost 400,000 jobs from July through September of last year, but new data released this week suggests none of those jobs ever existed. Now, I guess this is spilled milk now. I mean, this is over and done with, water under the bridge, pick your favorite cliche. But it still matters, David, in that we have to be able to believe the data coming out of supposedly neutral government agencies to make proper economic forecasts and calculations.
Yeah, I need to rely on this data. I've done this for a long time, quarter of a century, because we go to the government agencies, we pull down the data from all these various agencies and use it to make, our modeling, predictive modeling of what's happening on the macro side of the economy, right? On the broader stroke. And then it's not just us that called this out a while back, right? First Trust, Brian Westbury, a nationally recognized economist, one of the best out there, called it. We've had multiple folks actually say, okay, this is getting to the point we cannot trust the data. And now here they are admitting it. Oh, yeah, we lied. Oh, that was weird. You mean just the 90 days prior to the election, you might have fabricated some numbers? That's weird, Chip. Well, look, again, not a good sign. If those jobs weren't here, again, that tells you why the credit card numbers, the auto loans, all those things we just talked about are coming to fruition. Has nothing to do with the tariff tantrum that some people are now going to blame the downside of the economy on.
Thank you for listening to the Retire Smart podcast with David Brooks. If you want to learn how to generate lifetime income, reduce your tax bill, and maintain your lifestyle in retirement, visit retiresmartpodcast.com. And make sure to subscribe to keep up with new episodes every week.